We see explosive green candles on decentralized finance charts and assume we're watching human discovery happening in real time. We aren't. The initial momentum on these charts is driven almost entirely by automated sniper bots executing sub-second trades. These algorithms don't read project roadmaps or assess community sentiment. They operate blindly, strictly executing hard-coded heuristics to decide where to deploy capital. They are scanning the blockchain for specific triggers: minimum liquidity thresholds, developer wallet balances, and contract metadata. There is a specific, highly repeatable exploit currently active on the Solana network that actively weaponizes these exact algorithmic triggers. The objective is simple: engineer synthetic market momentum to attract and ultimately trap human capital. To understand exactly how this exploit functions, we have to stop looking at the market through the lens of human psychology and start analyzing it through the rigid logic gates of an algorithm. The first step in executing this trap is establishing a false fundamental premise to trick the bots into initiating buys. The token deployer identifies an unaffiliated, high-net-worth address, a whale, and embeds that address directly into the new token's transaction structure. When deployed, block explorers parse this structural link, displaying the token alongside a massive wallet balance. Sniper bots scan the contract, ingest this external link, read the massive SOL balance, and output a signal: high probability of major liquidity. The bot calculates that a highly capitalized developer is backing the project. In reality, the token creator has absolutely no cryptographic access to those funds. It's a visual spoof. But reality is irrelevant to the algorithm. The primary security filter has been successfully cleared. This immediately positions the token ahead of standard organic launches by forcing aggressive automated accumulation right out of the gate. The deployer succeeds by socially engineering the bot's automated risk assessment protocol. The second pillar of this exploit relies on the precise tuning of the token's initial liquidity pool. This split screen shows how the deployer balances the automated market maker formula to maximize visual price elasticity. With high initial liquidity, an incoming buy order barely moves the needle. On the right, with minimal liquidity, the exact same order causes a violent upward shift. A high liquidity approach creates a sluggish chart. It fails to generate the sharp percentage gains required to attract human momentum traders. But dropping the liquidity to zero carries its own operational risk. Extreme low liquidity triggers a separate algorithmic safety filter. Bots interpret an empty pool as a honeypot and will instantly abort all trades. To bypass this, the deployer calculates an exact mathematical threshold, roughly 3 SOL, threading the needle between those two forces. This precise starting parameter guarantees that the very first cluster of bot buys will translate into massive upward price momentum. The aggressive price action is a deterministic feature of the pool's shallow parameters. It is entirely detached from actual market interest. The explosive green candle on the trading chart is an illusion. It is a reflection of engineered low supply rather than high demand. The final technical variable is tuning the transaction fee to artificially shape the order flow. The deployer programs a fixed 2% transaction fee into the contract. This creates a threshold that rejects microscopic spam, allowing only larger, standard bot orders to pass through to the pool. Visually, this filters out the chaotic spray of algorithmic noise. The resulting trading chart displays clean, distinct volume blocks that mimic organic trading patterns. With the spoofed metadata in place, the liquidity mathematically optimized, and the fee filter active, the token is deployed. The exact moment the token goes live on the blockchain, a flawless, deterministic chain reaction executes in a matter of milliseconds. Automated systems instantly scan the contract. They clear the spoofed metadata filter, confirm the minimum liquidity threshold, and execute heavy buy orders. Within the first few seconds, massive green candles populate the public trading chart. Now the ultimate target arrives: human momentum traders, actively scanning aggregate charting platforms. These traders look at the carefully filtered chart and misinterpret the programmed synthetic spike as genuine insider accumulation or explosive organic demand. Acting on that misinterpretation, they inject real capital into the highly elastic liquidity pool. In this engineered ecosystem, automated bots act purely as the ignition switch, while human momentum traders serve as the combustible fuel. Once sufficient human capital has entered the pool, the trap snaps shut. The liquidity pool is now swollen, containing real external capital right alongside the deployer's initial base funding. At peak saturation, the deployer executes a standard smart contract function to instantly remove 100% of the underlying liquidity. For the human traders holding the new coin, their tokens are mathematically stripped of all underlying value in a single block. From the first bot buy to the final drain, the entire life cycle of the asset was completely dictated by its starting parameters, not by actual market dynamics. This reveals a structural flaw in how we analyze decentralized finance. The system's core vulnerability lies in the predictable logic of the algorithms interacting with the smart contract. As long as automated trading systems blindly trust easily manipulable on-chain heuristics, engineering synthetic momentum will remain a highly profitable exploit.